Bitcoin, blockchain, and beyond. So I would posit, and I'm interested to see if you guys agree, that few areas of finance get as much hype as Bitcoin, or more specifically, its underlying building block, the blockchain. You speak to blockchain evangelists, and for them, it's a breakthrough on par with the creation of the internet, with double-entry bookkeeping. You now have an opportunity to eliminate intermediaries. Two people can transmit value to one another without a trusted third party. That is undoubtedly revolutionary. The question is whether it's useful, and that's one of the things I want to discuss. Skeptics point out that we've seen hype around Bitcoin and blockchain before. When Bitcoin itself launched, people thought that it was going to usurp the dollar. It was going to become the way that we were all going to pay for, coffees and our subscriptions to The Economist. And in fact, it has not happened. As a consumer phenomenon, I think Bitcoin has been a bit of a flop, and I know, again, that is likely to elicit some response. We have three eminent thinkers and doers around Bitcoin today. I'm going to ask them to start off by introduce themselves, starting with Barry, and going on to John and then Mac.
Hi, good afternoon. So Barry Silbert, I founded a company called Digital Currency Group, and it is our mission to accelerate the development of a better financial system. And we do that by building companies and investing in companies and leveraging our insight, our network, and our access to capital. To date, we've invested in 58 companies within the Bitcoin and blockchain space across 18 countries. And we've started two companies. One of them is the manager of the first publicly traded Bitcoin vehicle called the Bitcoin Investment Trust. The other is a digital currency trading business called Genesis Trading.
Alphabetically, I'm just reading the list of companies you've invested in. They include BitGo, BitPay, BitPagos, BitPay. I mean, it goes on for
There's a lot of bits and a lot of coins. Yes.
John.
John Clevenger, definitely in the Bitcoin. I'm with the MIT Media Lab, the Human Dynamics Group, and working also with a cryptocurrency group there as well, and founded, along with Sandy Pentland from MIT, something called ID Cubed, which stands for the Institute for Data-Driven Design and Institutional Innovation. It's a real mouthful. But what we've been interested in doing is developing sort of open source software around giving people control of their identities, also their personal data, and how to design new kinds of what we call digital institutions, also using smart contracts to create new kind of regulatory models. And believing that if you're going to move into a digital age and scale it, you're going to have a new kind of infrastructure, a more decentralized infrastructure. So we've been building software, something called Open Mustard Seed was the first version. Now we're moving into other versions of that. We developed a set of principles called the Windhover Principles around personal data and individual sovereignty over your personal identity, and working with different regulators to develop these new models.
Okay, so I run Millennium IT, which is a software company. We do trading platforms for exchanges, clearinghouses, depositories, and I think perhaps best known by the acquisition by the London Stock Exchange a number of years ago. And so we run today about a third of European equity trades every day on our platform, but we work with exchanges, clearinghouses, depositories around the world, and have a real focus on the post-trade space, especially where we're bringing new real-time trading environments into post-trade, which is an area that needs a lot of modernization and is the area where there's a lot of interest right now in distributed ledger, especially. Yeah.
So I want to get to distributed ledger and to the whole blockchain thing, but actually I think it might be useful for the audience who may not be Bitcoin specialists to start with Bitcoin itself. I mean, there was a lot of hype around it. A lot of excitement, and in fact, it hasn't really happened. You can't really go into Starbucks and pay with Bitcoin, and if you can, nobody really does. I mean, is Bitcoin dead from that point of view? Are we ever going to see it used in lieu of fiat currencies?
I guess I'll start.
Yeah, you're meant to be the evangelist.
Yes, well, so I'm going to do my usual speaking shtick. So I want to do an audience survey. So by a show of hands, on the spectrum of Bitcoin skeptic to Bitcoin believer, put your hand up if you're a proud Bitcoin skeptic. Raise them high.
Including blockchain or Bitcoin?
Bitcoin. Okay, this is a hostile audience. Okay. And then how about who are the Bitcoin believers? Hands up high. Okay, now some friends in the audience. So, well, first, let me first establish what Bitcoin is. Bitcoin is three things. Bitcoin is a digital currency or a store of value. Bitcoin is a financial rail on which money can move around the world, and Bitcoin is a ledger system. Your comment around Bitcoin not living up to the hype, I think, is primarily around Bitcoin as a store of value and as a rail. And I think everybody should remember that Bitcoin was invented in 2008, hit the market in 2009, and for the first 2 years, no one really cared. And over the past 18 months, some of the largest companies in the world are now accepting it. There's some really interesting innovation going on. And we're now approaching this month $1 billion of venture capital investment flowing into the space, which is really kind of on track with the early internet days.
Okay, actually, can I turn your ploy against you? Hands up, anybody who has used Bitcoin to buy something in the past 6 months. Actually, that's actually it's not a lot, but it's a lot more than I thought.
Well, so I'm going to make the first unpopular comment of the day. Unpopular comment is I believe that the killer app, the primary use case of Bitcoin, it's speculation and greed.
Right, and crack cocaine.
And crack and other bad things. No, it's by the way, I should mention, since Silk Road was shut down, the level of online activities buying illicit bad things has skyrocketed. So shutting down Silk Road certainly didn't stop that. But the unpopular opinion I have is people are buying Bitcoin at 250, 260, 270 today because they want to make money, and that's okay. Because if the price goes up, you have a larger monetary base, you have a larger addressable market of people who own it, you'll have more merchants that want to accept it, you'll see more liquidity, more volume and velocity, and ultimately it becomes a better set of financial rails to move money around the world faster, cheaper than any other alternatives. You will be able to send money to India at 3 o'clock in the morning using Bitcoin if things really take off, and it will completely transform the financial system. But the only way that's going to happen is if the price goes up, which is why, again, I think the killer app for Bitcoin is greed and speculation. But I'm also the first to admit Bitcoin, the price is either going to go a lot higher today or it's going to zero.
This isn't part of your core business, either of you, but you must have some thoughts as to, would it help if Bitcoin were popular?
Well, I take a little different view on it. I think that, and I'm not sure you can separate Bitcoin from the blockchain. I mean, the blockchain is more interesting to me. I think Bitcoin is the libertarian currency. It's digital gold. It's predicated on that. You mining gold is a scarce resource, and I think so. There's an identity crisis going on because it's trying to be that, and then it's also trying to be something what was defined as a sort of demand-backed currency, which is like more of an informational currency. And I think, in my own view, is that you see a fork that's happening in the Bitcoin Foundation itself. I mean, they're being housed at MIT, and it really cuts to the center of sort of what that protocol is. Particularly, there's a notion of proof of work as the consensus algorithm, and arguably that has real issues in terms of not only energy consumption, but also there's a 51% attack. There are a lot of questions around that, but more fundamentally, there's an argument or a debate within the community about how big the block sizes should be in order to do transactions. And it sort of breaks down on an ideological basis, because they say, well, you've got to increase the block size in order to increase the efficiencies. And so the more those who are commercializing it right now want to do that, will lead it to a more concentrated, centralized service.
We're getting to blockchain stuff now, as opposed to pure
but they sort of all tie together.
Right.
So my own view is that as a speculative currency and trying to be a rail, I just don't think that works. And so I think you're going to see some variance.
I tend to agree with that. I think that I'm thankful for Bitcoin. I think many of us in the industry are in terms of the focus and the investment. But I think, frankly, the paradigm shift that blockchain and distributed ledger and the infrastructure, or the new infrastructure that the industry is looking at, frankly, eclipses Bitcoin as in terms of value as yet another currency. I mean, we have many currencies. And so I think it is somewhat ironic that we have perhaps a very different discussion today in the industry to what a lot of the more libertarian initial initiatives were. But again, to me, all the discussions that we're having now around a much broader impact for a new infrastructure for financial services is truly phenomenal.
And that seems to be the consensus, right? I mean, a year ago, everybody was very excited about Bitcoin, and then everybody started writing, well, Bitcoin might not be useful, but the blockchain really is potentially revolutionary. Why is the blockchain potentially revolutionary?
Well, one, I'll say that in 2016, the narrative is going to change again, and it's going to be back Bitcoin blockchain, Bitcoin the currency, Bitcoin the rails, really exciting. And it's really amazing, in my opinion, how quickly the narrative changed from what it was 12 months prior, which is, tulip bubble Ponzi scheme to every bank, thinking about it. And look, the reason why the blockchain, for those of you who don't know what blockchain is, essentially think of it as a open, transparent, distributed ledger where information is stored within this ledger by the system, where you don't have to rely upon a trusted third-party intermediary to basically say this person owns that, or they sent this person to that person. And if you think about what I just described, unfortunately, that's kind of Wall Street by and large. And so if you think about all the different businesses that will be impacted by the elimination of middlemen, it's significant. And so the reason why people are excited about it is because you can change the way that assets, ownership records are held. You can change the way that trading happens. You can create decentralized exchanges. You can change post-trading settlement. But what you're seeing right now in the headlines, and if you kind of read the stories, is that Wall Street is trying to find alternatives or something other than Bitcoin to use because of some of the real issues that were raised earlier around some of the Bitcoin network's limitations. But certainly in my opinion, ultimately they're going to revert back to the Bitcoin blockchain, because the reason why it's so powerful is because it is an incredibly secure network whose capacity is going to go up over time, and it is completely distributed and decentralized, so you don't have to basically ask anyone's permission. And the level of innovation that's happening out there is pretty amazing. And the reason why I say you can't separate Bitcoin from blockchain is because the reason why it's secure, the reason why it can do all these things is because you have tens of millions, probably hundreds of millions now of dollars that have been invested to mine Bitcoin. And these miners, these businesses that are being built, the financial
computer centers.
You think of them, like big kind of computer centers being built in Iceland and Chile and Northwest US and China, where energy costs are low. They're securing the network. They're basically processing transactions on the network. And the reason why they're doing it is for this financial incentive, which is a Bitcoin. So if you eliminate kind of the financial incentive, they're not going to do it, and then you don't have a secure network. And so essentially what the banks are doing right now is talking about creating these private shared ledgers, which is not innovation. DTC has been trying to dematerialize stock, get rid of stock certificates for 20 years. And DTC is owned by the same banks. And so ultimately, again, in my opinion, the innovation is going to happen with Bitcoin blockchain, and it's not going to happen at the banks. It's going to be on the periphery.
Yeah, I mean, I struggle to get that excited about the way that banks settle derivative trades with each other. I mean, if the promise of blockchain is like to revolutionize global finance, that banks can shave off a little bit of cost doesn't get me that excited. But Mac, you might disagree. I mean, it's exactly what you're trying to do, right?
Well, again, I think to put it in perspective, it's not shaving off a few basis points.
Yeah, right.
We're talking a massive sea change in how we operate the financial system over time. And I think we have to be realistic of how long that'll take. But again, I think we need to look at the convergence, and it's an amazing convergence of things that are happening right now. Since 2008, there's been ongoing cost pressures since the crisis for the entire financial system. We have ongoing regulation, which doesn't stop, whether or not it's in the States or in Europe. Again, 75% of all of bank spending is really just keeping the IT machine running, not changing, just running. And at the same time, we have, for the first time in my career, an appetite to really change. I see a generational shift in people making decisions on the future of architecture and IT. These are people who have grown up on open source, who have grown up on Agile, and who have a much more open view on technology and who are now calling the shots. And so again, it is a fairly radical view to look at banks working together in any shape, form, in a distributed ledger form, where you don't have this siloed approach. And so what will that mean? That will mean terrific efficiencies, cost efficiencies. It'll mean much more rapid services for consumer and knock-on for wholesale and capital markets. And all of that will have a knock-on effect into the wider economy. And it's going to take 5 years, it's going to take 7 years, it's going to take 10 years as the waves come. But we're not talking shaving a couple basis points off of clearing a derivatives trade. We are talking tremendous change, and that will benefit everybody. And that's why I get excited. We're not talking about using Bitcoin on small retail transactions. That'll continue, but we're talking about fundamentally making more efficient the entire financial system. Those are big words, but we see many ways right now, many use cases for distributed ledgers, and both in an open and also in a permissioned state. And I think we're going to have all kinds of different ledger environments, some open and some closed, some permissioned. But the aggregate impact of that, I think, cannot be undermined. Yeah.
Well, I'd like to comment on that. I totally concur with that. I think that what's happening is that you're moving from a hub and spoke model, a fairly hierarchical model, to a totally distributed model, a networked model, and not only in terms of the bank but the regulations. And so when you distribute things like that, you have the capacity, the opportunity to have new kind of regulatory oversight. In other words, one of the things that we're looking at into the KYC and AML side, but also sort of compliance and privacy laws, is that you can have smart contracts running regulations, and you do it through API calls. That's a very different way of thinking about regulation and your business model. I think the business model for banking changes. I think you're going to be able to create self-executing contracts. They can be derivatives. They can be self-executing, be verified and signed on the blockchain. So it's a different kind of competency. I mean, to me, it reminds me of my experience when I was first in the internet, talking to newspapers, and they would say, it's not going to happen. It's not going to affect us. What's this guy, Craig Newmark? That's giving away classified ads. That will never affect us. And what are portals? And maybe we'll buy a portal. But now you look at the market cap of the New York Times, it's $2.5 billion. The market cap for Vice is $3.5 billion. It has been, it's not, they haven't gone, some of them started going away, but they've been marginalized with respect to a whole new kind of ecosystem that's come in. And it's counter to their current culture, their traditional culture. I think you see the same phenomena happening in banking.
So you answered my question just as I was about to ask it. Who gets hurt by blockchain? I mean, if blockchain does really take off, it does become this way in which people can interact with each other without intermediaries. Who are the intermediaries who we no longer need?
Well, let's first talk about Bitcoin as a currency, Bitcoin as a rail, and let's talk about who that helps. In a world that is moving to connected mobile devices in emerging markets in India and throughout Africa, Southeast Asia, it is unlikely that JP Morgan is going to set up a branch on many corners throughout Africa. But everybody has a mobile device. Most of them are smart connected devices. So you're seeing via Bitcoin the ability for anybody with a device to have basic banking functionality.
Well, sort of. I mean, not necessarily through Bitcoin. There are a lot of, non-Bitcoin based financial services providers in Africa and emerging markets.
So anybody who buys a mobile phone in Kenya can, as soon as they open up that phone via Bitcoin, get access to a savings account, get access to a lending account, and can send money anywhere in the world. The second that they open up that phone. That is not, there's no other product out there that provides that. And so if you think about the economic activity, that'll likely be spurred by the ability to have assets, to have savings. and the ability to borrow money and ultimately be able to kind of raise money for small businesses, it's going to have a pretty dramatic impact in these emerging markets, and that's who it's going to help. And ultimately, who it's going to hurt, the banks, J.P. Morgan is not going away. But I think the whole, the definition of a bank is going to change over the next decade, regardless of what happens with Bitcoin. We're already seeing disintermediation of banks, and I think capital formation is going to change, where you're going to be able to raise money globally, and whether it's over a rail like Bitcoin or something else, it's exciting what is going to happen. But if it is your job to get paid to say that somebody owns this, or if you try to create a closed garden to control a market, you're gonna get put out of business by this idea.
And when you say somebody owns this, if it's your job to say somebody owns this, JP Morgan's job is to say you own this account, right? So we're talking about the very, very fundamentals of banking. Yeah.
Trust, right.
You were nodding your heads both.
Well, I was just thinking, this reminds me, there's a great quote by Bill Gates when he said, banking is necessary, but banks are not. And, he made that quote 25 years ago. And, back when there was a new wave of tech vision. And, the banks are still here. And I think now what's exciting, we have, a new, fresh look at technology and infrastructure. But certainly, we're not looking at the banking system going in a way that's more efficient, more competition. I do think there will be winners and losers in terms of people that make certain choices on whether or not they go to an open network or closed networks. There will be people in the value chain. When you look at trade to post-trade, and there will be, on the clearing side perhaps, or depository side, there will be some winners and losers. But generally, I see efficiency throughout the value chain and everybody benefiting.
Just to add to that, I think that part of the innovation is not just the decentralization, the self-executing contracts and ledger and things like that, but there are also a lot of work that's being done in cryptography and zero-knowledge proof. So there's a whole way of, I think when we talked about information sharing, it was just, okay, people think, oh, you're sharing photos and things like that, but actually, they're key, the information become an asset, and you have different kind of asset classes, and who controls that asset? It's becoming very critical. When they look at who controls a drone, who controls a satellite, right now the military doesn't know that. They can't, they say, well, when push comes to shove, do we control? We don't know. So there's a whole massive effort to create a secure infrastructure and be able to have signing and verify the chain of custody for data. And that's happening sort of independent of Bitcoin or anything else.
Right.
And that is also being built into the mobile phone. So there's certain standards in the mobile phone right now, the TPM.20, you have trust zones, you have ways of being able to do open and provisioning and signing and for establishing a chain of custody and data on the phone. And that's going to be the world's device. So you're able to create secure infrastructures, and you can be able to audit those infrastructures and sign for them, whether you call it blockchain or some other kind of technology. That is where the trend is going. And that competency and that be able to do that highly flexibly in a networked world rather than a siloed world is a different kind of competency. And that scales very fast. And it's an API world. It's not just siloed. It's not an information retrieval. Information is something that's continuously, necessarily flowing all the time. The Internet of Things is going to drive that as much as anything else.
I'm wondering, you've already alluded to the fact that you can use Bitcoin's blockchain to do things, or you can use a separate blockchain, which is the approach that most financial institutions are interested in. I'm quite interested in exploring why one is better than the others. One thing that strikes me is banks are really fearful of anything that could link them to bad things. They tend to get fined $1 billion at least as soon as anything bad happens, right? They don't necessarily want to put anything on their systems on Bitcoin, which still has like a lingering reputation for paying for crack, for lots of money going missing. This is like early days stuff, but it still kind of lingers. It just makes me think like people are going to use that technology pioneered by Bitcoin and are going to use it in a different way, right? So new blockchain. You seem to think not.
Well, I think they're going to fail. And I think ultimately the people working on these projects at the banks are going to end up leaving the banks to work at startups that are building it outside. Ultimately it's very difficult to drive innovation in a bank today, given the oversight and the regulation. And I think the idea of getting two banks together, let alone 10 or 20 in a room. I mean, it makes my head hurt just trying to schedule the meeting. And if you think about,
but it is happening, right?
I mean, there's a lot of talk, there's a lot of interest, but anybody who has worked on systems at banks can tell you it takes 2 years to deploy any basic system. So we're 5-10 years out from any of these efforts actually turning into a product that can be used. And while that's happening, it is my belief that the Bitcoin blockchain is going to address a lot of the issues that were mentioned before around security and scalability. And ultimately, the innovation that's going to happen, which will be adopted by the banks, is going to be done outside of the banks. I think it's great that they're doing it. I think it's fantastic that the narrative of the past 12 months has changed from, this is, Tula bubble Ponzi scheme to recognizing it's a very, very powerful technology. But we just need to look at the history of technology on Wall Street, and it's just innovation doesn't come from the banks on Wall Street.
I mean, would you agree with, you sometimes hear that what banks want to use or financial groups is a watered down version of blockchain. It's something that ultimately they control. The whole point of Bitcoin now is anybody can have access to the whole thing, right? Everybody can see what everybody else is doing it, and only cryptography helps you. The financial institutions are much more, let's have JP Morgan with a copy of the ledger, Goldman Sachs with a copy of the ledger, Deutsche Bank with a copy of the ledger, but everybody else keep out.
Look, I think the key thing is that we end up with interoperable standards. Frankly, I don't think we should be religious on the the underlying standards and the plumbing. And I realize a lot of people feel very passionately about that, who've been involved from the beginning. But again, I'm looking at a higher use case, kind of a meta level of implementing this overall architecture. So again, there will be a lot of discussions. There's going to be a lot of different camps, both within the Bitcoin and blockchain world, but also within financial services. And that'll take time to shake out. And I think your point about 5 years plus is absolutely right. But again, as long as we end up with something that's interoperable, that's the point.
Which goes against the bank model. I mean, ultimately, it's controlling the information and creating these closed walled gardens. And so I would be surprised if anything that comes out of these efforts is ready for anybody to plug into.
We've got about 10 minutes left. I wanted to see already if there, oh my God. Let's start. Gentleman in the back there. I think you need to wait for a microphone. It will come to you. We'll come to you afterwards. I don't think I've ever had so many hands go up in a panel I've chaired.
So one thing
And if you don't mind introducing yourself.
I'm Danny Shader from Pay Near Me. Something people often say is the first use case they talk about for Bitcoin is disrupting consumer-to-consumer remittance internationally because Western Union, MoneyGram are so expensive, blah, 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 blah. And the thing that I've not understood that maybe you guys can maybe justify is it strikes me that if I'm one of those international players, the cost of moving money from the United States to another corridor in one net settlement a day is not material as a percentage of each individual transaction. So I've not understood why this technology matters for the consumer remittance business until or unless the currency that you're using in the destination country is Bitcoin. Because I don't get why it would be cheaper to settle in Bitcoin, take dollars, convert to Bitcoin, and then convert to pesos to cash out than it is to just, for the large players, than to just use whatever existing settlements exist today. When you look at that as a percentage of divide that into all these individual consumer transactions. Is that something you guys can speak to?
Yeah, I mean, you're right. So we've invested, I mentioned 18 countries. So we have investments in the largest exchanges, Bitcoin exchanges in India, the Philippines, Mexico, Kenya, South Africa. And it's really not been up until really this year that you could see any movement of money cross-border from the US or UK or otherwise into these markets at rates that were competitive with a Western Union or MoneyGram. It's certainly faster. And I think the bet that people are making is one, as liquidity increases at the other end of these corridors, the costs go down. But ultimately, the bet is exactly what you said, which is, I think where this becomes very disruptive to Western Union is if the recipient doesn't ever need to exchange it back into rupees or pesos. And that the reason why they would do that is either because their local currency is getting deflated out of existence, which is happening around the world, or if they're able to buy goods or pay their employees or pay suppliers in Bitcoin, and it's just a much faster kind of round trip. But we are seeing it. We have one company called Abra, which I think was brought up earlier today, which abstracts out Bitcoin. You don't know you're using Bitcoin when you send it across the Abra network. Another company we have is called Align, which is also doing the exact same thing, but they're kind of smart routing. They're looking at what are the various ways I can send money as a small business from here to there, and if it happens to be Bitcoin, great. If it happens to be Swift, that's what they use.
Unless either of you want to comment, we can go to our next question. There was somebody in the front. Yeah, no, it's better. And if you can introduce yourself, please.
Leah Costello, a small business owner from Canada. And I'm going to ask a question that is just completely back to business fundamentals, in the sense that businesses have receivables. They rely on collecting them in a timely way. And there's a lot of businesses in certain industries that rely on the ability of keeping that process very slow. And so I think about an example like Walmart. They're obviously very slow to pay suppliers, and that's part of their business strategy, and they make a lot of money doing that. Can you talk a little bit about the industries that are going to be disrupted from the business point of view, about making financial transactions quicker and getting over the cultural hangover of slow transactions being a reason for slow receivables?
I'm not sure that Walmart is. I'm not sure the problem in you getting your money is because of the time it takes for the money to get there. It's more Walmart being. Yeah.
Strategies.
Yeah. John, come on.
All right. Well, I think that. I think it's going to be less. You're going to be less able to justify that, and I think that in some sense that you can make the payments faster. You can actually, one of the things that we're looking at, you can put things in escrow accounts and have smart contracts control the escrow accounts and then release it through API calls. And I think so. You're moving to a different kind of environment and a different kind of incentive system and probably a different set of norms that they're going to govern that. But this idea of smart contracts and escrow accounts, I think is one area that'll come into that.
Well,
I want to talk about smart contracts.
Okay.
Anyway,
I'll just kind of give two examples. So there's companies out there that are using Bitcoin blockchain to create efficiency around trade finance and bill of lading in particular. And so if you're familiar with how container ships move across the ocean, there's a piece of paper on which everybody signs, and ultimately financing is provided off of it. If you could put that into the blockchain, so a trustless system, you as the buyer of the goods can track it along the way, and it will dramatically reduce the amount of time it takes to actually kind of get the money paid to the actual supplier. The other is a company that is putting every diamond of certain investment grade onto the blockchain. So starting from the mine all the way to the consumer, creating an identity on the blockchain for diamonds, which again deals with kind of conflict diamonds, but also from a financeability and securitization perspective, it creates some really interesting opportunities. And there's a lot of examples, and happy to talk to you afterwards about your business.
Can we talk about smart contracts quickly, because they are extremely cool, but some way into the future. John, you've alluded to them a couple of times. I mean, the idea, as I understand it, is you basically have kind of machines running. Well, I mean, when I was at something called the Law Lab at Harvard, and one of the things, this is 5 or 6 years ago, and one of the things we wanted to do was put basically term sheets on and self-executing contracts, and that you could change the language of the term sheet, and then you could see the impact on cap tables. And then you could design contracts that perform to a certain standard. So, I mean, really, when you think about what a contract is, it's language, but if you turn it into algorithms, and then you can prove that this algorithm executes in this way that can be signed, you create enormous efficiencies. So now there's a lot of talk, particularly in Ethereum, would use smart contracts and creating a language to write contracts that are self-executing and autonomous. And so we also did prototypes around regulations, COPA regulations for child online protection. I mean, what happens there is a kid goes, age changes, geographic location changes, people who they interact with change. It's very hard to enforce it.
But when you use when you use smart contracts, and you're tracking what the person's doing on their phone, you know when they're birth, you know where they are in GPS, you know who they're talking to, and you can adjust it by jurisdiction and enforce a regulation that way. So I think there's that, and having self-executing contracts around certain kind of in financial instruments it just opens up a door to a lot of things. I mean, having said that, I think that when you look at some of the attempts to make this fully decentralized, and whether you have what they call Oracle's ability to pull information in, and there's a lot of computational complexity around that security. But anyway, all right.
Yeah, I absolutely agree with you, John. And I think next year we're not going to be talking about the price of Bitcoin. We're not going to be talking even really much about the blockchain, which is just the plumbing. We're going to be talking about smart contracts. This is really going to fundamentally change how we're viewing the transaction of value. And can
you give an example, like a tangible thing where we are going to be interacting as consumers with smart contracts?
If you look at whether you're looking at capital markets or even back to more retail, small business transactions, having the transaction out there on the blockchain with driven by external events, data-driven events, where it's fully visible and lives on and is trackable. I think that changes everything in terms of going from the siloed environment that we're at now. So it's something that we need to absolutely look at how that transforms the next 5 years. It's going to change what a software company is, because we're coding the actual contracts into the code. It's going to change what a law firm is. It's going to change many things.
Yeah, just to add on the law firm, because that's something we looked at a lot, is that if you look at a lot of legal agreements, they're pretty standard agreements, and you're getting standard agreements, and people are agreeing into that, in, say, the Venture Capital Association, and what should be a standard agreement. And so if you can codify that, and you provide sufficient credentials that people agree to a certain kind of legal contracts, and you can sign for them, then you present a credential, and then you can get a loan. You can greatly streamline your business and compress the legal costs of that. I think that's an inevitable thing that's going to happen. It'll be resisted by law firms, but some of the law firms are looking and anticipating that happening and trying to
come on, we'll always have lawyers come on.
Is
this investable yet?
Yeah, for the number.
Yeah, for what it's worth, I think we're years away from smart contracts impacting any of us here in this room. I look at electronic signatures and how long that's been possible, and I'm still getting lots of legal documents that I'm actually hand signing. And I do think that next year we will be talking about the Bitcoin price, personally.
Okay, we've got a bet.
We have time for one or two more questions. There's one back here.
Hi, I'm Kathleen Camilli. I'm an economist. Question about central banking, monetary policy making in light of the development of Bitcoin.
I'd love to take that one.
Please.
As a non-economist.
When is Satoshi going to raise rates?
People who get excited about Bitcoin, they tend to start reading books about the history of money and debt, and I've been one of those people. And I think what you come to appreciate pretty quickly is, with all due respect to central bankers in the room, over history, over the past 400 years, the average life of a government or fiat currency is 27 years. And so currencies get destroyed typically through war or debasement. And if you look around the world today, there's a currency war, either it's happening or it's about to happen, where you're seeing economic activity being stimulated through the creation of money. And history has shown that is a failed strategy. So the reason why people are excited about Bitcoin is because there's a finite supply, it's scarce, it's fungible, it's highly divisible, and you can predict the growth of the money supply. The inflation rate drops in half next year, and then every 4 years thereafter drops in half again. And so it creates a very interesting economic case study and experiment, and it really is this kind of Keynesian versus Austrian school of economics. And I think ultimately, in my opinion, predictability and transparency is the right policy, which Bitcoin provides and central banks don't.
Guys, any return to the digital gold standard?
Yeah, I may be obvious that I don't subscribe to that point of view, but And I think there's some really interesting ideas of how to rethink the role of a central bank, particularly when you move. I mean, this is a much longer conversation.
And actually, we have 14 seconds left.
We're saying, because actually, you're moving to information economy. It's not a question of scarcity. Actually, information is not a rivalrous good. And so you have a notion of increasing returns. And actually, what you want is circulation. You want to have everyone have it rather than create a scarcity. And that creates a different set of incentive mechanisms. But I won't.
And we now have 0 seconds left. It sounds like a topic for another panel. Please, will you all join me in thanking John, Barry,
Thank you.